We've now had 9 rate cuts since the summer of 2024, and the overnight rate from the Bank of Canada has dropped 2.75% from its peak, almost 3%. And yet, Canadians still don't feel any kind of financial relief. So this update is less of a celebration of a low rate and more of Canadians trying to understand what is actually going on with their mortgage over the next 12 to 24 months. I personally believe there are 3 groups who really need to pay attention to this right now. The first group are those renewing in 2026, especially if you bought in 2021. This group of people are facing the biggest payment shock in Canada. If you locked in around 1.3 to 1.5%, you're probably heading into a renewal somewhere in the 4% range. And this is where we see a $700 to $900 per month payment increase on a typical 2021 purchase. The second group are those who have a high 4 or even a low 5% mortgage rate. And if your mortgage rate has a 5 in front of it, it might be worth running the penalty math now to see if switching early or refinancing can help you save some money with today's lower rates. And the third group are those thinking about pulling equity. This could be for debt consolidation, it could be for a refinance, or looking at a second property. For this group, today's lower rates change the math, but only if the cash flow still works after your refinance. And before we talk about actual numbers, I want to take a quick minute to go over the 3 buckets lenders use. The first bucket is an insured mortgage. This is a high ratio, which means we're putting less than 20% down, and it's under the insurer's or CMHC's price cap. And this is owner occupied. That section or that bucket is the lowest risk to lenders, which means you're going to find the best and lowest rates. The second bucket is called conventional insurable. This is where we put 20% or more down, still owner occupied, and the property itself still fits into the CMHC guidelines. On these, you don't actually pay the insurance premium yourself, but your lender can insure things in the background. Oddly enough, rates here are slightly higher than those fully insured files. And the third bucket is conventional uninsurable. This is where things like refinances live, rental property purchases, second homes, 30-year amortizations, and homes that are above the insured limit. These mortgages can't be default insured, so your lender carries more risk, which means you're gonna see higher interest rates. Keep those 3 buckets in mind as we talk about numbers, because your bucket matters more than the headline rate that you see on social media. Now let's talk about where real-world files are roughly landing. Keep in mind that this stuff changes every week, but this should give you a good frame. The first one is an insured purchase. This is where you get the best pricing on rates, as we mentioned before. So on strong files, a 5-year fixed insured is landing around the high 3s, 3.94%, whereas a 5-year variable insured is sitting around the mid 3s, around 3.65%. These are basically your classic A lender deals, which come with solid income, good credit on a normal property. They basically set the benchmark for pretty much everything else. Next is conventional insurable purchases. That's 20% down, it's still owner occupied, on a 5-year fixed is often in the low 4s for strong files, and a 5-year variable here is coming in around 3.75%, so high 3s. Essentially, the more plain Jane that your file or application looks to a lender, which means you have T4 income, you've got clean credit on a standard home, the better your chances are of landing in the lower end of those ranges. Then we've got conventional uninsurable, which is where we see refinances, rental purchases, 30-year amortizations, and higher value properties. Here, a 5-year fixed is often coming in around the low to mid 4% range. We were seeing some files coming in a little bit lower if you were willing to trade a bit of flexibility for a lower rate. But with the recent increase in our Canadian 5-year bond yields, that is pretty much set now. And that brings us now to the fine print. Behind those cheapest listed rates that you see online, there will always be a catch. You'll often see things like a bona fide sales clause, which mean you can't actually break that mortgage until you sell the property. They also come with weaker prepayment options, heavier penalties if you need to get out early, or some restrictions on switching lenders in the middle of the term. On paper, it sounds great. You're saving 30 to 40 bucks a month, but when and if life happens to you, whether that's a job change, a separation, you're growing your family and have another kid, or you need to pull some equity, you can typically end up getting handcuffed to a lending product that doesn't really work for you and doesn't move. So the rule of thumb here is pretty simple, but if a rate looks unusually low, don't get too excited too soon until you know exactly what you need to give up in order to get it. Now, this next one is a big one, but let's talk about the 2021 renewal shock. Back in 2021, you could get a mortgage for 1.3 to 1.5% on a fixed rate, and you could probably go lower if you went variable. Payments were very comfortable for people. Prices were still felt high. So what people did is they stretched their borrowing capacity just to get in. But now you fast forward to 2025, 2026, that 1.5% borrowing rate is gone. Renewals are now coming in around the 4 to mid 4%. So on a typical 2021 purchase, when you keep a similar amortization, we're now seeing payment increases anywhere between $700 to $900 per month. What some families can do to soften the blow is extend their amortization out back to 30 years. That'll soften the payment shock. Other families will be totally fine, but this is exactly why you don't want to wait for your renewal letter to show up 30 days before your maturity on your term. You really want to start planning in advance to give yourself more tools or more options. Now, let's zoom out for a second and talk about the 9 rate cuts we've seen since the summer of 2024. You would think that the housing market would be on fire, but there are a few things holding it back. First, which is quite obvious, we still have an affordability ceiling. Even with lower interest rates, home prices are still very high relative to the incomes that we make. And on the stress test side, that still forces you to qualify at a higher rate than what you would actually pay. Second, confidence in Canada is shaky. We're seeing a lot of Canadians return finance vehicles just to keep their monthly budgets afloat. So if that is you, you're definitely not out shopping for a bigger or an upgraded home. Third is job quality. We've added overall jobs in the recent print, but overall, that job growth has been part-time replacing full-time, and half of that has been isolated to Alberta. So people are essentially working more hours for less security. So that doesn't scream, hey, I'm confident to upgrade or upsize my home right now. So even though borrowing costs are way lower than they were at the peak, on the demand side, things are a bit shaky and people are still nervous. And that is why prices have not been responding the way they normally would or the way people would expect them in a normal rate cut. So what should you actually do with this over the next 12 months? Well, let's break it down into 3 simple groups again. The first, if you are buying next year, this hold means your pre-approval rate is not changing this month, but you do not want to build your plan on the 2.25%. Talk to your mortgage broker and make sure you run your numbers at either 1 or 1.5% higher than today's rate. Because if your budget only works at the lowest possible rate, I would say that is a red flag, something you want to avoid. More importantly, if you are going to live in a home for 5 to 7 years, the exact month that you buy is going to matter less than whether your payment still works if rates go back up again. 2, if you're selling a home, these rate cuts alone have not triggered a surge in pricing. If you are waiting for a spring boom rate cut cycle, I would say you need to manage your expectations because in BC right now, this is a market where realistic pricing is winning. It's definitely not a time to test out a hopeful or fantasy list price. And the third one is renewals. If you are renewing next year, especially if you bought in the year of 2021, this is where you need to be very proactive. Step 1, you need to get a renewal preview. Figure out what your payment looks like at today's rate. Step 2, check in on your equity. You might have room to refinance if you need to clean up some other debt or if you need to stretch out your amortization. And step 3, once you are in that 6 to 12 month window, make sure that you grab a rate hold early. Even if you don't have much equity, you still want to know what your future payment looks like so that doesn't blindside you. So what does all this mean if you are in British Columbia? Well, first-time homebuyers are now finally seeing a 3% interest rate on insured files. And conventional buyers and people who are refinancing are seeing percentages in the mid to low 4s. And your bucket, whether you're an insured, insurable, or uninsurable mortgage, combined with your decision between flexibility and lowest possible rate, matters far more than that headline rate that you see online. But if you're anywhere in BC and you want to know where your situation fits, whether you're buying, you're renewing, or you're thinking about refinancing, reach out. I'll put the link in the description below, and I'll run your numbers together with you through a number of different scenarios. Together, we'll look at your income, your debts, we'll take a look at your property, so you're not comparing yourself to some generic example online, asking yourself a ton of different questions. If this was helpful, hit like and subscribe, and I look forward to seeing you in the next video.